Hello students, in our previous lecture we are solved illustration number 7 on computation of total taxable income of partnership firm, and we discuss only how to compute the tax liability of partnership firm. Okay, we give an task to all students to compute tax liability of partnership firm. Here in our today's lecture we are going to start illustration number 8 on partnership firm. Here, problem number 8. Anand and Bhutan are the working partners in a business firm sharing profits and losses in the ratio of 3:2. The capital account of each partner showed a credit balance of rupees 1 lakh as on 1st April 2021. Following is the profit and loss account of the firm for the year ending 31st March 2021. So Anand and Bhutan are the working partners. Both are the working partners. His profit sharing ratio is 3:2, and the capital account of each partner show a capital balance of each partner on 1st April 2020 amounting to rupees 1 lakh rupees. His profit and loss account of it means firm's profit and loss account is given here as on 31st March 2021. Okay, 2021. So here profit and loss account is given. We read the debit side first. Okay, so profit and loss account of the firm is given here. So first of all we read the debit side, then we read the credit side. On debit side we identify the expenses which is not relating to the partnership firm. On credit side we find out the income which is earned from other sources. Okay, so here first of all read the debit side. To salaries, so it is a expenditure relating to the partnership firm. Okay, to salary to staff. Okay, so salary to staff is allowable expenses of partnership firm. Then to salary to partners, Anand 34,000, Bhushan 34,000 in outer column amounting rupees 38,000. So partner's salary is add in net profit. Then we get a deduction of remuneration for working partners under section 40B. Interest on capital, Anand 18,000 rupees, Bhutan Bhushan uh, Bhushan here Bhushan amounting to rupees 18,000 in outer column 36,000. To office expenses, so interest on capital, if the rate of interest on capital charged to partners capital is given, then we compare the rate of interest with exempted rate of interest. Okay, if not given, then we find out the percentage of interest charged on capital of each partner. Okay, so interest on capital exempted up to 12%. To office expenses, so it is a expenses relating to the firm. To municipal tax, so municipal tax is paid on property, so it is not expenditure relating to the partnership firm. It is not expenditure relating to the partnership firm. So here we identify the first expenses which is not relating to the partnership firm. First expenses, that is to municipal tax amounting to rupees 2,000. So municipal tax is paid on house property. Okay, but it shown on the debit side of profit and loss account of partnership firm. So the municipal tax is disallowed. Okay, so we identify the first expenses which is not relating to the partnership firm. Then repairs, so repair of machinery, repairs of car, it is relating to the partnership firm. Okay, so repairs is relating to the partnership. Donation, so all donation are disallowed. Okay, so here we find out the second item which is not relating to the partnership firm, or second expenses which is not relating to the partnership. Then bad debts. Okay, bad debts is given here. Okay, if the bad debts is disallowed, then we add the bad debts in net profit. If it is not disallowed or the information is not given on bad debts, then the bad debt should not be taken into consideration as a disallowed. Okay, so here bad debts, here any other information relating to the bad debts is not given, so it is allowable expenditure of the firm. Then provision for bad debts amounting to rupees 2500. So any provision is disallowed. Provision for bad debts is disallowed. Then to depreciation 6000. So here depreciation is allowable expenditure of the firm. Okay, okay. So here 6000 is allowable expenditure. If adjustment is given, then we compare the value of adjustment and actual depreciation charge on the debit side of profit and loss account. Got it? Then net profit, that is 4000. Okay, net profit is given here, that is 4000, and net profit is considered. Okay, so net profit is considered to find out actual taxable income or total taxable income of partnership fund. So here uh, we identify the three expenses which is not relating to the business. Now we read the credit side: gross profit, rent from house property. So it is a income from other source amounting to rupees 12,000. It is income earned from other sources. And interest on post office saving bank account, it is also in income from other source. Okay, so here we identify the two incomes earned from other sources. Okay, now read the additional information. So here donation includes rupees 1000 paid as subscription to trade association and the balance to the national defense fund. So donation given to National Defense Fund and subscription to trade association. So all these are the disallowed expenses. So whole donation is disallowed. So whole donation amounting to rupees 4000 is disallowed. Okay. Then next, municipal tax paid and repairs pertain to house property. So here municipal tax, we already identify the municipal tax is relating to the house property. Okay, but it is a house property, it is a expenditure relating to the house property, so it is disallowed. As well as in adjustment number second, the repairs or the repair expenses is also relating to the house property, is also relating to the house property, so it is also disallowed. So make a star uh, in front of repairs, because additional information is provided. As well as we make a red to repairs, because repairs is not expenditure relating to the partnership firm, because the repairs is pertaining to relating to the house property, so it is a expenditure relating to the house property, so it is disallowed. Then next adjustment, that is allowable depreciation, is given here. So allowable depreciation as per income tax rule amounting to rupees 5000, and here the depreciation is charged on the debit side of profit and loss account. Debit side of profit and loss account, that is 6000. It means the depreciation is charged by rupees 1000 is excess. So here excess depreciation is charged on the debit side of excess depreciation is charged on the debit side of profit and loss account. So excess depreciation is disallowed. Excess depreciation is disallowed. So we make a star in front of depreciation, because additional information is provided on depreciation, that is actual depreciation on assets is amounting to rupees 5,000. Okay, with the help of the above information provided by partnership firm, we have to compute the total income of the partnership firm for the assessment year 2021-22. Okay, so here we identify the expenses which is not relating to the partnership firm, and we identify the income earned from other sources. Uh, here for preparation of solution, it is very easy. While we identify the expenses and incomes of the partnership firm which is not relating to the partnership firm. Okay, so here solution. So solution computation of total taxable income of partnership firm for assessment year AY 2021-22, PY 2020-21. Now prepare three column, that is particulars, amount in rupees, particulars, amount in rupees. Okay, so here rupees, then here net profit as per profit and loss account. So net profit as per profit and loss account is given here, that is amounting to rupees 4,000. Okay, amounting to rupees 4,000. So consider this net profit 4,000. Then we add what we add inadmissible or disallowed expenses. Add inadmissible or disallowed expenses debited to P and L account. Profit and loss account. Profit and loss account. Profit and loss account. So here we identify the expenses, that is to municipal tax, one by one. To municipal tax amounting to rupees 4,000. Then next expenditure, that is repairs here. Then repairs. So repairs is relating to house property amounting to rupees amounting to rupees 500, amounting to rupees 500 here. The figure is given here, amounting to rupees 500, 500. Okay. Then next expenditure which is not relating to the partnership firm, that is donation. Donation amounting to rupees 4,000, amounting to rupees 4,000. 1 2 3 4 5, amounting to rupees 4,000, amounting to rupees 4,000, amounting to rupees 4,000, amounting to rupees 4,000. Then next, amounting to rupees 4,000, amounting to rupees 4,000. Then next expenditure, that is to provision for doubtful debts, provision for doubtful debts, amounting to rupees 2,500, 2,500. Okay. Then next, that is depreciation. So excess depreciation, that is 6,000 minus 5,000. So the excess, that is amounting to rupees 1,000, 1,000, amounting to rupees 1,000 rupees. So excess depreciation is amounting to rupees 1,000. Then next expenditure. So next expenditure, so read the additional information. Here we taken into consideration all expenses which is not relating to the partnership firm. Now we read the additional information. So donation is also taken into consideration, repair is also taken into consideration, and depreciation is also taken into consideration. Now here the interest on capital, the rate of interest on capital is not given in additional information. So here we make a working note for finding out the rate of interest charged on partners capital. So here 1,000, sorry, the capital of each partner is given, that is on 1st April 2020 the partners capital account show a credit balance of rupees 1 lakh rupees. So 1 lakh rupees, and the rate or the amount of interest charged is given here, that is 18,000. Okay, so 18,000, 1 lakh is equal to 18,000. Okay, so for 100% is how much? For 100% is how much? There is question mark. How much? Okay, so here we compute we make a cross multiplication here. Okay, cross multiplication, 100 multiplied by 18,000 divided by 1 lakh. So answer is equal to 18%. Okay, 18%. So here remember the formula to compute rate of interest on partner's capital charged by partnership firm. So here the partnership firm give an 18% interest on the capital of partner. So excess interest on capital is given here. So excess interest is this one. So add excess interest on capital of each partner. Okay. For Anand, amounting to rupees 18,000, 18,000. We deduct less 12% exempted. So 12%, how we compute? So 12%, that is 18,000 multiplied by 12 divided by 18, not 15, 18. So here amount, exempted amount is find out. Okay, so here the exempted value or exempted interest on capital is rupees 12,000. Exempted interest, that is amounting to rupees 12,000, and the balancing figure is taxable 12,000. So here the balancing figure is taxable, that is 6,000. 6,000 is taxable. 6,000 is taxable. Now here again for Bhushan. So Bhushan is, so here the same interest is given to the Bhushan, same amount of interest. So 18,000. So here 18,000. 18,000 less exempted, that is 12,000. So remaining balance is taxable, that is amounting to rupees 6,000 is taxable. Amounting to rupees 6,000 is taxable. Got it? Yes sir. Got it? Yes sir. Okay. Now here we taken into consideration all disallowed expenses. Okay, all disallowed expenses. Okay, so here amounting to rupees 6,000. Now make the total of inner column. So here total of inner column is rupees 22,000. Put this total on the outer column and add this 22,000 in net profit. So here we received the amount, that is amounting to rupees 26,000. Got it? 26,000. Then next we deduct what we deduct here. We deduct the income charged or the income credited to profit and loss account earned from other sources, less income chargeable under other source. Okay, so the other source income is deducted from net profit. So here one by one. Rent from house, property. In inner column, amounting to rupees 12,000, amounting to rupees 12,000, amounting to rupees 12,000, amounting to rupees 12,000. Then next, that is interest. Okay, so interest on post office bank account, saving bank account. So here amounting to rupees 1,000, amounting to rupees 1,000.